Why condos are bad versus highest and best use triplex conversions east of the GTA. Why they're good and actually cash flow. Before we get to that, what are young people being taught these days? As your classic Asian parent, we want our kids to excel in their after-school activities. So naturally, we asked our kids' gymnastic club if they offer private lessons. The staff member's response, and note she is a teenager. Okay, whatever. Let's not practice ageism here. Her response was that would not be fair, as in that my kids would have an unfair advantage over their classmates. For context, the club is so busy, we were only able to get our kids into one class per week, which is not nearly enough if you want to be in competitive sports. So we're switching clubs. But still, what does fair have anything to do with anything? As Clint Eastwood famously said at the end of the Oscar-winning movie The Unforgiven, fair ain't got nothing to do with it. I can pull that off slightly. No, it's probably still pretty bad. But I have major grass allergies right now. Anyways, life isn't fair. And pretty much everything I've done in life was to get ahead. Work hard, stay late, working weekends, going to business school, investing in real estate, investing in coaching, into coaching for myself, to receive coaching, reading books, taking courses. I don't believe in fairness. I believe everyone has opportunities and everyone has the right to take advantage of those opportunities in life. I believe in winning as well and getting ahead in life. Fair is for communists. I wasn't born with any natural talents, so I don't expect my kids to inherit any. So they're going to learn to grind, and that includes doing extra work, including private lessons. Speaking of young people, I was checking in on one of my clients who hired a new property management company. So they have a new rental property, and they hired a new rental property management company, and the property hasn't rented yet. It's been 2 months since the property's been ready to rent, brand new renovation. 2 months have passed, and so that's bad. The market is telling you something. 2 months, that's bad. Peak rental season is the spring market because parents want to, no one wants to go looking at properties in the winter unless they have to. But generally, for most people, most of the time, parents want to settle in on a place before the next school year begins. And this apartment is a 2-bedroom plus den, so it's ideal for our family. I informed our client that he has only a couple weeks until school is out for summer. So that's when the official summer starts in my books. I reviewed his ads with him, and they're fine. They could be improved. I gave him some tips on how to improve them, including shooting a video. And that can just be a simple selfie camera. Just use your own phone, do the tour. You don't need to spend the money for a professional tour for a rental property. I told him how the ad could have been better written in order to target who the target market is and who the decision maker is. It was written very very technical. Versus I said, you need to paint a better story than that. And also the key thing that stuck out was the price was high. Again, the price has to be high because everything else was decent. Pictures were okay. But again, it hasn't rented. So you need to do something. I proceeded to review his competition in the immediate area in the same town that charged that were all similar in terms of number of bedrooms and bathrooms. Also, they were newly renovated in a new town. It's a small town as well. Anyways, so newly renovated 2-bedroom. His competition, they're asking for $100 to $300 less than he is. There's no one at the same price point as him, let alone higher. Some are even above grade versus not a basement apartment, but rather a main floor and second floor. If I'm a tenant, and that's a new build as well. So if I'm a tenant looking for a place, I'd probably choose that over my client's basement apartment. So again, I've identified 3 direct competitors in this small town with less than 50,000 population, all brand new renovations. I explained to our client that this is a competition. Who can get the best tenants? Who can rent first? Not just to anyone, but obviously you need quality tenants. But my point is that we're losing this race. Our client is the highest price. It's not going to work. Again, understand, my client has professional property management in place, and 2 months is too long before making any adjustments. So he needs to get more. He needs to take action. So again, this property is in a town that we no longer recommend. It's called Trenton, Ontario. We don't recommend it to clients as it appears that the market's saturated, as in too many investors with unrented properties. Again, there are 4 2-bedroom, newly renovated apartments available for rent in a town of around 43,000. So that's a small market. We've had lenders on this show, for example, who said they won't even lend in a market with that small. So yeah, affordable markets can be a double-edged sword. While prices may be affordable, if the rent gets too high, it makes better sense to buy, and that's what we're seeing in this market. Any reasonable person knows that real estate's a good investment. Hence, the top-end tenants, they're turning into buyers. They're choosing to buy instead of rent, right? So 2 months of advertising, no tenant is a red flag, especially in a small market, right? If you're investing in a small market, then you need to be even more cautious, right? You need to price things right. You need to get the things rented, because vacant property is risk, right? Like, no one goes broke having fully occupied properties with rent coming in. So yeah, a good reminder that even if someone has a property manager, especially a new one, you need to check in on their work, and in this case, lack of progress. Whenever you invest, do make sure you focus on economic fundamentals. Our other clients have. We've been working with clients since 2010, and if you just look back, our clients that purchased 11 years ago, they have tripled in value. So any of our clients that bought in 2012, their properties have tripled in value. Also, a lot of those were single-family homes, like we could cash flow those back then. Anyways, and also none of them experienced 2-month vacancies of newly renovated properties. And if they did, something was just plain wrong. On a macro level, what a world! It always seems to be fascinating, the world that we live in, and the level of history that happens. I don't geek out on world news and economics as many people do, but just to summarize, this is just my view of things. Our friends, the Americans, will raise their debt ceiling to avoid bankrupting the richest country in the world. And in response, the bond market predicts the Federal Reserve will increase interest rates another 0.25% this July or September, before cutting closer to November, December this year. In Canada, our economy performed better than expected, causing speculation that the Bank of Canada will raise interest rates again. My bet, if I had to bet, I would bet no rate increase, as inflation has already slowed the last few months. It's likely going to continue slowing. I believe that to be great news for even if rates go up 0.25%, which some are predicting. I think that's actually great news for buyers. Yes, it sucks that that everything gets more expensive, but it also slows the recovery of real estate prices. The recovery of real estate prices has been actually really fast. And by slowing the market down with a rate increase, that just allows buyers to find more great deals. And honestly, it'll also push off some sellers off the cliff that they can no longer afford, and again, making more great deals available. In the U.S. real estate market, we are seeing some serious problems. There's an investor whose name is Jay Gajavelli, hopefully I said that correctly, who owns Apple's Way Investment Group. And he has a fund that's making national headlines. The fund owns 7,000 multifamily units in Houston, Texas. Amazing, right? Not so much. Several other buildings are being foreclosed on by their lenders. This is why I say on the show, I don't care how many units somebody has. All I care about how much money is being made. And unfortunately, the investors of these in these funds, so the investors of these multifamily apartment buildings, they raised a lot of money to do so, and these people are going to lose some of their investment. I've included a link in the show notes. So anyway, again, just to appreciate, folks, people who provide fake news do not provide their sources. I will always attempt to source everything. Anyways, the article mentioned that the investor, his name is the investor Jay. He is coached by a Brad Sumrock. Me being nosy, I creeped Jay's Facebook, and he appears to be part of a large investors group under this Brad gentleman, buying apartment buildings. So some sort of education group, networking group. And as the old saying goes, where there's smoke, there's fire. So this could just be the early days of a number of foreclosures of apartment buildings in the United States. I even watched a local news channel in Houston, a local Houston news channel, report on how the mayor of Houston, the mayor of the city, and it's Houston, Texas. It's not some rinky-dink town. Several heads of department at the city, with both police and fire departments, showed up at Jay's property because it was being so badly managed. Broken steps and handrails, overflowing garbage bins, rats problems, etc., etc. Basically, my point is that there could be some great deals on the horizon for those with deep pockets and know-how. Here in Canada, we have lots of groups that promote investing in general in real estate and also multifamily investing. And as a result, a lot of my longtime apartment building friends across the country, good friend Pierre-Paul Turgeon, Michael Pawnee, who was just recently on this show, they've shared with me, off the record, there are many apartment building listings with multiple offers on them where the winning bid often makes no sense. Makes no sense financially. Time will tell if we see the same level of problems here in Canada in apartment buildings. Not to say all investments are bad. One just has to, put in the time and effort to find the good deals, as past guests of the show have shared how to, right? In case you want to check, we just had Mike Rockwell on and Michael Pawnee again. So from what our clients are seeing on the streets, from what our clients are seeing on the streets, we have Coach Steve Phillips here to share what our clients are experiencing, both the good and the bad deals, and what our clients are acquiring these days. The focus has more recently shifted away from smaller towns, smaller markets like 50,000 population, sub 50,000 population, to places like Kingston, Ontario. And Steve is here to explain why. With Bill 23, the More Homes Built Faster Act, and the densification that we're seeing lots of cities adopting Bill 23, allowing us investors to create more housing. So the point of Bill 23 is to reduce red tape, reduce building development charges so that we could build houses faster. Anyways, it's working. The bill is doing its thing. And between just our experience and all the education that we have done in the past, we kind of know what the highest and best use investments are. We just have to find the properties and line them up with the investors, our investor clients, to connect them with the ideal properties for highest and best use investing. Have you met Steve Phillips? He's a member of my team, the 4-time award-winning iWIN real estate team. Right out of school, he worked for one of the largest condo management firms in the GTA. So he knows condos very well. He's sold condos in the past as well. He's a serial entrepreneur. He's had a construction business. Real estate runs in the family, as the missus is a designer as well. Steve is well known in the Durham region, as that's where he grew up. Also, having been coached by and taken courses by Quentin D'Souza. Quentin's stuff is fantastic, by the way. If you know Steve like I do, he doesn't sleep well until his clients have a great deal under contract, and he'll be sharing how he's been doing so, along with the numbers behind the deals that we're transacting on in Kingston, Ontario with our clients. You can reach out to Steve at infinitywealth.ca if you'd like to book a call or tour. Again, that's Steve at infinitywealth.ca. Of course, links, and I'll have more contact information in the show notes. Please enjoy the show. Hello, Steve Phillips. What's keeping you busy these days?
Hey, what's up, man? A lot of things, a lot of new projects, a lot of happy clients, just getting ready to start some new projects. So it's been a lot of fun, a lot of good deals.
So you've been in real estate a really long time.
Yeah. So thank you for aging me. Yes.
Yeah.
Just turned 40 years old, and I've been in real estate in one way or another since I was 23.
Yeah. So 17 years. That's a long time. Can you share with the listener where you started? Where you started in real estate?
Yeah. So I came out of school in whatever year that was, 03, 04, whatever, somewhere around there. I can't even keep track. But I was doing marketing. I was doing marketing, and I always joke that I took marketing, got out of the program, and then 8 months later, Facebook was invented. And so that kind of ruined everything that I had just learned. So I ended up, my father-in-law, my now wife, my father-in-law owns a property management company in Markham, has done so for now almost 38 years. And when I first came out, he was in need of help. And so I fell into condo management as my very first job out of school. So I was running properties, townhomes, low rise, some seniors living, and a couple of high rise properties when I first started. And I just jumped right in. I was doing about 1,200 doors, or about 8 to 10 condo corps as my portfolio. And this was, before a lot of the new rules and changes and everything, but it was after the Condo Act had been put in place. So everybody was kind of just learning the Condominium Act. So that's where I kind of cut my teeth. I learned a lot about real estate that way, because the condo corps got to hire very smart people as accountants and engineers, architects. There's reserve fund studies going on, and lawyers are involved. And so I got a lot of time with some very, very smart, talented people that, had to teach me everything that they needed to know and that I needed to know. So it was a really cool crash course in condos right away.
It sounds like a whole bunch of red tape, but it probably very well needed red tape.
Yeah.
Bureaucracy. What do you mean you need an engineer? What do you mean you need a budget and an accountant and audit this stuff?
Yeah, listen,
that sounds good to me.
I think there's a lot of people that forget that condominium corporations are a legal entity. They are, after the bank, the only one who can take your property away for non-payment. They can enforce a sale or a power of sale on your property if you don't pay your management fees, your maintenance fees, your condo maintenance fees. And so as a result, they hold a lot of weight. They're very political. Board of directors are very, intense, and running board meetings can be very intense. And we would spend, I spent many, many, many nights running condo board meetings and annual general meetings and all of those things. So yeah, there's a lot of they're legal entities. They need to be run correctly. And so people forget that. Those status certificates that you order in a condo sale that just become like, yeah, who cares? We don't need to see that, or I'm sure it's fine. Those things are like so important. And as a realtor now, and I've dealt with so many realtors who are just like, yeah, I waived the status certificate condition. And it's like, well, did you read it? Like, did you at least read it? So yeah, there's a lot of things that you can do with condominium corporations that you need to be aware of as far as running them.
Yeah, I remember one condo building I was doing listings out of in Hamilton. They had a leaky underground parking. That's not a big deal, right, Steve?
Yeah. No, those are crushers. Those are instant costs. So when you're going through condo corps and you're trying to figure out like where's the risk, everybody that run into is always talking to me about the amenities. So they're very obsessed with the amount of pools and the bars and the rooftop patios and all of these things. But as a condo manager, you cringe, because those are all things that are now on your reserve fund study. A reserve fund study is going to take your costs for the next 30 to 50 years and force you to start saving for those items. So you want a whole building worth of glass? Beautiful. We're in Canada. Eventually all that glass has got to be fixed, repaired, or replaced. Eventually, maybe not in your lifetime, but it will be an issue. You need to start paying for that. All your boiler systems, all your mechanical systems. Just think about people who own apartment buildings. They freak when they look at a 20-year-old boiler. You are doing the same thing when you move into condominium corporations. You inherit everything that is in that condo corp. It is now, a portion of it is your cost.
So Steve,
sounds like fun.
I'm guessing you're taking all the fun out of condo ownership.
No, listen, at the end of the day, condos are not a new idea. They have been around for a very long time. It's a means of property developers fractioning up one single piece of property and selling it to many, many people. It makes a lot of sense on a lot of levels.
Yes,
the question is, it creates a lot of units and everything, right? But the problem is that, when you actually manage 800 people or 1,500 people living in one structure, going up the same 3 or 4 or 5 or 6 elevators, coming off the main levels, coming out the same exits, there's humans just don't operate or live that way naturally. You just have to remember that, right? Like, we didn't come from wherever we came from, starting out wanting to live on top of each other. That's not how this is sort of meant. So it's not a natural process. So you've got to get people used to it. There's noise, there's fights. There's been plenty of times where I had calls over disturbances and domestics and all of those bad things. And so, you end up in a very tight living quarters. And so you got to learn how to live with other people. And some people aren't good at doing that, and some people are. And so it's a process. It's definitely a process.
Mm-hmm. Yeah, I love where I live because I back onto a pond, so I have no back neighbors.
Yeah.
And part of that also means I don't hear many dogs bark. Right? Because dog barking was designed to wake people up.
Yeah, alert. Yeah. I have one of those. I have an alert system built into my house. Yeah.
Yeah. So I love living in the house. I don't think I could ever live in a condo because I don't want to be that close to people.
Listen, I've managed condos, I've sold condos, I've lived in a condo, I've been a board member of a condo, I've managed board members of condos. I worked for, insurance companies that were in charge of fixing the condos after fires and floods, and kind of help them out. I've seen a lot of things, kind of consulting with people and helping people manage how these condos operate.
Yeah. And
on paper, they make a lot. Yeah, all GTA. Right?
All GTA, including downtown
Toronto. Yeah, so somewhere out in the suburbs of, Mississauga, all the way through to Oshawa, and somewhere in downtown Toronto. But ultimately, ultimately they all have the same issues.
All right. So can you share how many condos you still hold, and how many condos you sell?
Absolutely none.
Why not?
Absolutely none.
I get emails like every week about this great project coming up and all this cash flow to be made.
Listen, there are a lot of people who've made fortunes in Toronto condos. So by no means am I here to tell you it's the worst thing you could ever do. It's not, but personally for me, what I talk to my clients is that we focus on highest and best use. There is nothing you can do with a box in the sky. There is nothing you can change to it. You are completely stuck as whatever its current use is, 1 bedroom, 2 bedroom. You can try to squeeze in. Listen, I've gone into units that were student rentals without the landlords even knowing, and sheets were being strung across lines, and they were all separated into like 7 or 8 living quarters in a 1 bedroom unit. So I've seen people get creative, but that's not the point. As a landlord, you can't do that. So you're in this spot where, you've got one use for that thing. It goes up as the market goes up. And as we've seen in the last few months, it will pull back, or months, years, it will pull back as the market pulls back, and it will rise again as the markets go up. There is a shortage of units in the city. That's a very valid fact. But the problem that I foresee is that you can never get the numbers to work anymore, because the average price per square foot to purchase is between, $1,000 to say $1,600 a square foot. And the average rent is sitting somewhere between $5 and $8 a square foot, maybe $10 a square foot. So you're in a position where you can't make the numbers really work. You're going to negatively cash flow month over month. That means the only play is speculation. That is not a real estate investment. That is just speculating that the market will go up. Therefore, I will make more money when I sell it. But until you sell it, you've made no money. You're losing money month over month.
I literally had a conversation with a newer investor just 2 weeks ago. Their condo's worth about $500 right now. It was at the peak. It was $550. They're currently negative $1,200 a month. And we got on the call and they asked me, should I sell? And I'm not, I don't have much of a filter, so I said, apparently that's a good thing. Good friends don't have filters. They don't dance around things. So I said, I can't believe you had to wait for this call to ask me if you needed to sell this.
Right. Right.
Because just simple math. Because maybe in 2 years to get back to peak. So maybe it goes up 50 grand. But in the meantime, those 2 years, you're gonna bleed close to $30,000.
Fair. Yeah, no, that's fair. I mean, that's what the numbers say.
All right, you're gonna guarantee bleed 30,000 for a chance at make 50,000 to go up 50,000. So there's a chance you'll net 20.
Yeah, that's it, right? Like, listen, I remember speaking with very heavily invested real estate, condo investors from foreign, typically they were the ones I dealt with were out of country. I would run into them once in a while. They would come and see their portfolios and I would meet them. And one of those investors one time told me that they treat Toronto condos similar to a safety deposit box. They put a bunch of money into them, they hold them, and they know that over time it'll be protected and it'll go up. And that makes a lot of sense. Okay, that makes a lot of sense.
Especially for buying all cash.
Deep pocket investors, right? Like deep pocket investors, you can make a ton of money and you really don't want cash sitting around nowadays. So, okay, that makes sense. If you're a deep pocket investor, good for you. That's a good play. Buy something that's, always going to be in demand in a neighborhood. Makes sense. I find that a lot of the time, the people that I'm running into are looking at condos like a get rich quick scheme. Like buy it on spec. They buy it on spec from the builder. They wait in the lineup. They get the red dot down. They try to then flip the property back out on paper in an assignment sale before anybody has to close on it. They take the capital off the top. Like those things, again, have worked. But when you don't have a lot of room or leeway or play in your investment portfolio, I mean, that can be very punishing when the market slips on you. You don't control that. Right. So deep pocket investors,
the market slipped and people are looking at taking baths, taking haircuts.
Yeah, and maybe not on all their maybe not every condo unit people are taking a bath, but it did. No.
I mean, like the assignment.
Why
market.
do that?
Right. I mean, like the assignment.
Yeah. Market. The assignment market.
Yeah. Sure. And just to be clear for listeners, like the assignment market means you've already bought something pre-construction. You have a contract. You're contractually the buyer. You haven't closed yet, and unfortunately, there's a lot of them. So from what I'm hearing from my friends in this market, is there's a lot of people looking to sell their contracts. So they're trying to assign them, and so if you're a buyer, there's probably less of them with rates being high, and also with large appraisals aren't coming in for pre-construction condos when they do close. So buyers are looking for deals, which often I think the starting point that I'm hearing from people is for the seller to lose their deposit. That's the starting point.
Yeah, and 800,000 or 900,000. That's a chunk of change.
Yeah, that's a chunk of change. All right. So yeah, and Steve, like you've seen entire pre-construction buildings that are completely investor owned, have you not?
Yeah, so like I've taken a few properties through the first year audits and the second year audits and the carry-on warranty process, and getting those corps through, what was happening more and more. And I mean, it's not rocket science. I'm not breaking hot takes here. 90% of the buildings are investor based, right? So you've got a lot of tenants living on top of each.
Right.
Each building is
right.
Each building is different, but generally speaking, most of the projects that have been sold in the last 5 to 10 years have been investor heavy. It's just what they are.
Can you the challenge is to can you ballpark how much of that's foreign versus local investment?
I can only speak to what I ran into, and it was some years back now. I've been out of condos for the last 5, 6, 7 years as we've been doing more and more conversions, but in my experience going through the process, I don't know, put a number on it, 60 to 70% were foreign at any given time. I think the laws have probably changed a little to make that a little less obvious.
This is pre 2017.
For
the foreign buyer tax. Yeah.
That's right. But I mean, for the most part, it wasn't uncommon to be dealing with one realtor who represented 20 or 30 or 40 investors.
Yeah.
And he or she were the point of contact for every unit because there was no address or direct contact for anybody else in the unit, like who owned the properties.
Right. And they
So,
probably
like,
didn't speak English. If you did have the contact.
you know,
How's your Mandarin,
yeah,
Steve?
but yeah, it wasn't so good. But you know, I think that ultimately, at the end of the day, the bigger problem with condos is not so much, for me personally, it's that I can't change the use. I can't do anything more with it.
Yeah.
And
Can't
I'm
even
buying
Airbnb it. Yeah.
now you can't.
Now we can't.
I'm buying a ticking time bomb because the fees only go up. And, sometimes you run into these condos and it's like, but the fees have been at this rate, 1% increase or a 2% increase for 7-8 years, right? My very next question is, how many special assessments have you done? Because the trick is, if I cap your fees and I just do an incremental, minimal inflation raise, you're still going to have a shortfall most times. And that shortfall then gets split out amongst the amount of owners there are into a one-time special assessment fee. If I want to sell my unit, I just pay off the special assessment before I sell it. And that does not apply to my status certificate. And therefore the unit is just the maintenance fees. So it'll have to be told that there was a special assessment, but at the end of the day, it's not encumbered. It's not an encumbrance on the new owner. I can take care of it before I sell it. So it's just one of those things. If every year you're being special assessed $10,000 or $15,000 a year, then your maintenance fees aren't real. Your costs are actually much higher, and people don't take that into account. They just look at the number that's on the listing page and say, that's what I have to put into my sheets. That's what I have to put into my numbers and spreadsheets. Mm-hmm. You don't know that. Look at a reserve fund study. They're pretty accurate on when your next payment or bills will be.
Oh, okay. It's good to know that the statements are accurate, though.
They have to be. Yeah, the reserve fund studies, there's engineers on the other side. They've got no choice but to be very accurate.
Very cool. Very cool. So Steve, you're saying in today's time, condo not good investment?
I'm saying that I would advise my clients that there are better options and optionality for an investor to get into a marketplace other than a condo.
All right.
Yes.
So what do you like? You're so picky.
I mean, yeah. So I'm big on the density, right? I'm big on density. I think that density is the future. I think that all of these things that we're seeing, if you look at it, go with the river, go with the flow of where the politicians are pointing you and pushing you, because you won't have as many obstructions to your plan that way. For a while, Airbnbs, and we've done talks on Airbnbs. Airbnbs were very much a good avenue for investors. They may still be, but if you go to the city centers, you're going to find a complete uphill battle in every large city center to kind of get your Airbnb through for the large majority of them. It's not the way the river's flowing. What is flowing is increasing density on existing infrastructure. So we're seeing people being able to do 3, 4, 5 units in Toronto on existing properties. You're seeing people be able to add garden suites and into laneway housing. So finding investment opportunities where you can take a current property that is at the end of its life cycle and increase its density, although this is very much a cost and capital intensive idea. If you are willing, or if you believe that your speculation in condos is that the market will take these prices higher, I would encourage you to look at other opportunities and properties in that same market space where you can buy in, find a strategy that will hold you over and pay your bills. And if, get you close to paying your bills, with the intention that as the equity goes up, you reverse that equity back into the property and increase the density. Maybe it's 2, 3, 4, 5 years from now. But the reality is that you at least have the ability to do it. You can change the use. If you buy a condo, a box in the sky, you have no choice. If you buy a property that has, a 30 or 25 to 45 foot, frontage and some depth to it, depending where you are, obviously, you can increase the size of that property, right? Or the density within that property. So that feels like a more strategic play. Then it just becomes, where do you do that? Where does that make the most sense?
So I don't know how I want to start this, Steve. Where does it make sense? And do you want to even touch on where it doesn't make sense?
Where it doesn't make sense is when you're in a bunch of new construction. So anything that's been built in the last 5 years, those houses for the most part are on very tiny, small lots. Really, really big house, very small lot. So right now, I don't know how that makes sense yet. It feels like that's just not going to work for the time being. Plus, the purchase prices are very high. You're paying up in the $900s, $1 million, depending where you are across the GTA. So that's kind of tough. That doesn't really make sense.
Yeah. Sorry, just to add to that, a lot of these houses with attached garages, there's no basement underneath those garages. So we actually lose a lot of square footage. So again, the business model doesn't really seem to often make sense for what we're trying to do. Because we want good sized basements because that's what tenants want.
Yeah, and I think ultimately, people will start to solve that problem as time goes. But you've got it's like an apple tree. If you're looking at the apple tree, you go and pull the best and the ripest first. Why waste your time pulling the one that's not ready to be eaten yet? I see those properties as part of like that unripened, not ready to be eaten yet portion of the tree. There are way more opportunities right now because we're at such an early stage to this new strategy that there's no reason to go force yourself to make something very complicated work yet.
Yeah, because I get this, I speak to novices all the time. It's only because we're in this industry doing this regularly every day. Like I got chirped on the weekend for calling our strategy boring, because for a novice it's actually quite exciting. To us, it's like we like boring, we like repetitive, we like low hanging fruit.
Yeah. Okay. So where you were chirped is kind of important too, right? But I think ultimately, look, here's the deal, right? A lot of people get into real estate investing, and sometimes they're not going into it necessarily with eyes wide open. Sometimes you need to look at it like, what's best for you? Do you really want to own 100 doors? There's a lot of people who tell me, at least I talk to people, and they tell me they want to own 50 to 100 doors. And then when they actually wrap their head around what that means, they take a beat and they think about it. They're like, actually, I don't know. Maybe I don't. You don't. I don't think you do. Unless it's like, most of the time those people that's a business. You've created a business structure, and your business needs to have a lot of moving parts. You need to be able to manage it. You need to be able to find it, fund it, and all these things.
Yeah, it's a new career.
Yeah, if you have a real job right now, like a lot of the people we talk to, they're executives, they're marketing people, they're doctors, they're lawyers, they're people that are careers are already established.
Yeah, they're already career-wise, they're already in their highest and best use.
Yeah, there's no reason for them to be taken out and try to figure out how to start becoming a real estate entrepreneur in that degree.
We're not saying don't do it. It's just that for most people, most of the
time,
might
not be your highest and best use.
Yeah, it might not be your best highest. Yeah, and also you're risking a lot.
Understand that you're taking on another job. I think that's the biggest thing, right? You're taking on another job.
I was talking to a multifamily investor, for example. Like, say you're negative $200 per unit. Right? I was talking to an apartment building investor, a pretty good one, and he said you're negative $200 per unit and you have like 3 duplexes, right? You can probably survive that. You're negative 200 across a 100-unit portfolio. So each unit, you are
month over month. Yeah. And not to mention, you're probably not sleeping. Your stress levels are high.
Yeah.
Your family life suffers.
Yeah. Your tenant profile is likely very different.
What are you accepting by doing this? So sometimes it's ego driven, sometimes it's driven by FOMO, sometimes it's driven by seeking of cash flow. Just like they're like, I'm just looking for cash flow, and I can't make the cash flow numbers work on a duplex. I totally understand that. For me, I always tell my clients, it's the number for me when I do the math is usually like 650,000 to 700,000. It gets really tough after you get over that on a duplex or a single family to make anything make sense. I get that. But this new avenue and what we're seeing as far as Bill 23 is concerned, as far as the city of Toronto doing their density bylaw changes. Other cities are following suit. I think you really need to reassess or look at whether multifamilies and large apartment buildings is actually what you need. Maybe you just need 2 or 3 or 1 really, really good conversion project that kicks out a good chunk of cash flow for you, and has a minimal management quality to it. It's very simple to manage. There's only 3 units or 6 units. You don't have to manage 600 and still generate, in some of the numbers we're seeing, $1,500 to $2,000 a month of cash flow, depending on how you're buying them.
And Steve, you are actually, apologies to the listener, I know Steve well, so I actually know you're finding cash flow.
Yeah, no, I am, and I don't put people into that. Now, at the same time, I'm very much encouraging my clients to get creative, because this is going to be not the common thought process for a lot of people. They're not looking at it the same way. Mm-hmm. But I am walking them through these processes to show them and kind of, I don't know if it's just take a lot of the fear away of what a renovation construction project could be if you're adding these densities. It's not easy, right? It's not. Finding an apartment building that's not on MLS that has good cash flow and returns, it ain't easy either. So,
You're talking about months and years of process to get those deals to come to you.
Networking, it's nothing's easy if it's worth getting, right? So at the end of the day, I just really want people to start to look at these projects, and I'm here to kind of work with my clients to break down the fear hurdle that they have to get over. Right. It's mostly fear. There are professionals like architects and planners and designers and high level contractors and things like that are going to do a lot of the heavy lifting for you. You just need to be able to kind of know the vision and know where you're going, and that's mostly what we're doing for a lot of our clients jumping into this strategy.
And since your clients are my clients, what I tell clients is I have the question all the time, like, why don't you buy apartment buildings? And I explain to them the stabilization period is 5 years, right?
Yeah.
Money's going out the door for 5 years, because you're like, for many, they're paying tenants to leave and then they're renovating. And so you have like 10 units, every few months you're renovating a unit. That's just money going out the door, right? Versus I invest in our clientele invests as what I call a side hustle, as a part-time thing. And so, even though it's not easy per se, but our renovations are usually done within 6 months, right? And then I'm done.
Yeah,
I can wipe my hands clean. My property's rented, and I can go back to living my life, right? Sometimes over like 3 months, but again, I don't have to worry about it. Versus like a 5-year stabilization period. And so for most people that are in their highest and best use career, right? Get back to living. Get back to your career. Get back to your day job. Get back to living. And just let the market do its work.
Yeah. I would just add, I didn't interrupt you. Just to add, like, you're also now new construction 2018. Rent caps are subject to change, right? You're not following that older thing. You've also got typically brand new everything in a rental. If you do a renovation project, for the most part, you've updated and that property inside and out. Mm-hmm. So you're not absorbing any old boilers or any old systems that are going to break down on you. There's really no surprises once you get through a project like this. Yeah.
We have permits. We even have independent city inspectors come inspect it, right?
You've got, and you've problem solved any solutions that need to be done. So I think ultimately there's a lot of, tangible things that happen, and there's also some non-tangibles that are all benefit to the strategy. So, mm-hmm. So where does it work? That was the question you're asking me. So for me, I'm out here on the east side. I like to put my clients into the mindset of having a bit of exposure to larger market appreciations. It's just facts. They're going to run up faster when the market starts to climb. Larger city centers with higher populations are going to rise faster. And then we kind of add to that, and we put in some smaller markets that make a lot of sense as far as fundamentals are concerned, with job opportunities or location. And then we put that into play as well so that there's some higher cash flow from those smaller markets because the prices are cheaper. So right now, for me, it's Kingston as my big city and Belleville and Quinte West as my smaller markets, maybe Napanee, maybe. Ottawa is kind of also on my mind. I'm looking at it a lot right now. The numbers are significant and they're high in Ottawa, but I have a lot of my clients actually calling me from Ottawa. So our clients are calling from Ottawa. So what I'm looking at when I'm talking to Ottawa people is they're like, I just can't make anything work in Ottawa, so I'm looking for a new market. Well, then maybe your smaller market is Kingston, but don't give up on Ottawa, because I think if you can get the capital together and get some of the properties in some of the prominent neighborhoods of Ottawa, you're going to do a lot of big numbers there. And Ottawa, I think, will have to follow suit to what Toronto's doing very soon. Its population is exploding, and they've kind of sprawled to the far reaches of Barhaven and Canada and Streetsville and anything they get their hands on. They're expanding very quickly. So Kingston for me right now is the prominent city center that I'm looking at. And the last 4 to 6 months have been very Kingston oriented for our clients.
Can you walk us through some recent deals that you've been doing with clients in Kingston?
Yeah. So the way that I'm looking at this market, obviously by no means did I grow up in Kingston. It's not a market that I've been there for, a decade. So I put it in the perspective of, I like markets that I haven't grown up in. I'll tell you why. I come in them with open eyes, and I don't have recency bias. I don't have location bias. So I'm not looking at that property that's there and remembering when that property nostalgically sold for $400,000. That happens to a lot of people when they've grown up in a town. They can remember what it was. They can also remember what that property has always been used for. So I don't come to cities with those perspectives. What I do is I spend about 6 to 8 months really diving into a city, learning the ins and outs in the streets. And then I take the strategies that I know from other larger markets that I've worked and are working, and I start to figure out how they can apply to this marketplace. So I'm now into this Kingston market for a substantial amount of research and time. What I've found is that the best avenue is to kind of be close to the university for some of those density projects. Queen's University obviously is in Kingston. I'm looking at the southwest side of Kingston, city center, for those density projects to try to increase units within those footprints. For the most part, a lot of our clients are seeing the best avenue as additions and bump outs and things like that on a lot of those properties. If they do have an existing garage, which we've just had one, I think you showed it on your student rental webinar a few weeks back, it already had a 900 plus square foot garage on the backside of one of these properties. So we're going to use that structure and go through the process with that structure. But that structure is going to come with some variances and some things that go along with it, which just, part of the process. So ultimately, we've been looking at those as our main deals in the last couple of weeks. And if they are existing student rentals, I think it's worth noting that it's getting harder to finance student rentals. The lenders and the banks are not so happy, or they're not jumping up and down to get student rental deals right now. So getting those main properties to be duplexed or triplex, and then looking at adding units either in garden suites or additions is kind of the angle there. To the suburbs of Kingston, we just had a deal close on a property that we're going to probably do some content on very soon. Our clients, again, coming from the Ottawa area, purchased a bungalow, raised bungalow with a walkout basement to the back on a 80 by 176 foot lot. And it had a garage that was built by a gentleman that had his dream of having this perfect man cave shop garage. So the garage already had toilets and plumbing, already had 100 amp panel, already has a basement, which is very uncommon. The back half had a basement included, which you're not going to use as living, but it's good for mechanical rooms and things like that. And this property was purchased for under $650,000 in a fantastic neighborhood. We're going to duplex the main house, and we're going to convert the garage into a garden suite unit. When all is said and done, we're looking at somewhere around 2,300 on the top floor. I know you like numbers, so I'll give you some numbers.
I think
2,300 on the top.
Our listeners like numbers because
if they follow you, they like numbers. Yes.
Just a quick comment about numbers, because I like dollars, right? I like dollar numbers. I think the whole like with all these new influencers out there, they're always talking about like units or I don't know, whatever number. I care about profits. I care about cash flow. I care about profits, about improvement to your net worth. Those are the numbers that matter to me, right? I don't care about any other metric. Sorry, continue.
Okay, so we're seeing like 2,300 is probably the number that we're going to be getting for the top floor.
Mm-hmm. Plus utilities, or plus some utilities?
Plus some utilities, probably hydro at the minimum. But we'll say plus some utilities for the time being. Lower level, probably somewhere in the neighborhood of 1,900 is what I'm hoping for on that. It's a big unit, and it's got very high ceilings and windows and a rear separate entrance. The property itself, far off at the back of the property, has some, really nice, like there's no neighbors directly, to your earlier point. There's no neighbors directly behind this property. So there's a lot of space. It's just a really good environment. So 1,900 is more than reasonable out of that basement. And then the garden suite, we're going to be pushing into a 2,200, 2,100 at the minimum, plus utilities, because it will be separated off. So we'll have that kind of structured that way. So
right. Yeah, for the listeners' benefit, a garden suite is essentially like a tiny house on the property in the backyard. Right.
Yeah, this one's actually adjacent to the main house. It's like right beside it.
My apologies. Was this one an existing garage, or
this is the existing garage? This is an existing garage. Yeah. No, I might have been not clear about that one.
This is like garage suites. Yeah, that sounds like a terrible name. I'm never going to advertise a garage suite on Kijiji. I'm going to call it tiny home. I'm going to call it a tiny home. I think that's pretty.
All right, listen, this is the thing that when you're looking at these projects, every city is going to call them something different. Kingston is unique because their 3-unit bylaw that they passed last year has numerous names for these structures. So this one is going to be probably an ADU, accessory dwelling unit. Some can be called tiny homes. Some can be called garden suites. It actually depends on a lot of nuance within the building of the structure as to what it gets. But for this particular one, it'll be ADU. So it's a pre-existing garage. We're looking at a build-out cost very similar to what we see in our duplex conversions. Somewhere around $125,000 to $140,000 is the budgeted number for both the basement conversion and the garage separate, so double that $120,000 to $140,000. But when all is said and done, the numbers are there to support it. It's in a very, very good neighborhood, and we anticipate the values to only go up as appreciation and market increases.
And then, so I've run the numbers, and the cash flow is quite significant, assuming you're paying a lot of cash. But the amazing thing was, even if you're paying entirely home equity line of credit, you actually have a chance to be slightly positive still.
Yeah, I would agree. And I think that for a lot of my clients, what they're doing is this is the time period in which we anticipate, or smarter people than me are anticipating that you're going to see a dip in interest rates probably into next year.
Yeah.
You're going to try to take
term.
I think ultimately there's a refinance probability into this time next year of where the clients are going to look to pull some, readjust and probably not just pull some cash out, because pulling cash out kind of kills cash flow, but restructuring debt so that it is carried correctly. I think that's more an accurate way of describing it, just to help the cash flow numbers go. And all of our clients are not taking a very short, narrow approach to this. There is a very long 5, 10, 15-year horizon on these investment strategies, because they're, listen, like you're in your late 30s to mid 50s, you still are actively working, you're still making income, you're hoping to have something put aside for future use and for family. You're creating revenues through a business that you have. These things are all still happening in your life. Most of our clients are not on the on the sidelines of their career, living on beaches. That's not my typical or our typical client. They're still actively working. They just are trying to put some really good hard assets together so that they've got something put away for when the day comes that they want to be on a beach.
Mm-hmm. Mm-hmm. And then what about tenant profile? We mentioned Queen's University is nearby. Are we renting to the students? Are we renting to, who are we renting to?
So here's my approach to all of this. I think that students are always going to be a demographic of tenant profile, right? In Kingston and in Queens. I always remind my clients or anybody who's talking about student rentals, like when these beautiful homes were built in the 1920s, 30s, 40s, 50s, like they were not, if you had told the person who built these houses that you were going to chop up their houses and put, 5 to 8 20-year-olds into these houses to live in, they would have burned it down themselves, like they would never have allowed this to occur. These homes are beautiful, right? Like great neighborhoods with big old trees and things like that. So students are a profile, yes, but I think it is becoming increasingly more beneficial to create, as opposed to just chopping up bedrooms, creating duplex or triplex units with unit mixes of like 3-bedroom, 2-bedroom, 2-bedroom. Kingston, for example, has an 8-bedroom cap on every property. So you can never put more than 8 bedrooms on any property in Kingston as of their new bylaw. Before you could, now you can't. Right. So you need to find a unit mix within those 8 bedrooms that gives you the highest cash flow potential out of each unit. I think that then allows, when you start to separate the houses up that way, it allows you to be a little bit more diverse in your tenant profile. You could have some students. You could also get some grad students. You may get a young professional or two if they're not all having to live like dorm styled, sharing of one kitchen type of house. So chopping up the houses also expands your profile, your tenant profile, into a different tenant use mix. Kingston as a city is young because of this vibrance of the university. Anecdotally, I've been talking to a lot of people. I live out Prince Edward County way. Talk to a lot of the people that live here, business owners, prominent people. A lot of their teenage children go to Queens. Just happens to be the generational, process. I'm hearing more and more from these people that their kids just aren't coming home from Kingston. Like they thought they would finish school and come home, and they're just now 22, 23, living with a couple of friends. They've got jobs, or they've got a job in Kingston or remote, and they just like the city. It's a really pretty city. If you've never been there, it's a really beautiful, pretty city, prominent waterfront, just really great energy there. It's a bigger city, so it's got, a bit of things you got to live with and places you don't always want to go. But for the most part, very, very, very pretty city and safe. So people are just hanging out and they're staying there. So I think you've got a mix of young professionals, you've got a mix of students, grad students, and then you've got the hospital there, and you've got nurses and doctors and things like that as well.
Yeah, my experience in, for example, my St. Catharines properties have a similar experience. I'm seeing I have some graduated students who just stay with their friends in the property. Which I'm fine with. They make an income. I still have their guarantor form signed from their parents. So, I'm fine with that as well. But yeah, things are changing. Things are changing in terms of...
I think you just, listen, I think you nailed it. I think if you talk to the people that are in the educational system, mm-hmm. I think the education system is changing. I think universities are going to be changing over the next 10, 15 years. I think young people that are looking to enter a job market are changing. So I think all of these things kind of have to be taken into account. The only thing that's constant is change. And we are in a very, pivotal change right now. You've got a lot of things happening on a macroeconomic level, a lot of things happening as far as tech is concerned. And I think just in general, as real estate investors, or as people working with real estate investors, we have to keep remembering that just because you've done it for the last 25 years, you may have to find a new way to kind of deliver.
I'll say two things about that one thing that hasn't changed is I don't know when real estate hasn't been a good investment for the areas that we operate. But
Yeah.
I'll add something that I hadn't told you about it yet. This past weekend when I was at the conference, at a conference, I met a custom home builder who just launched a product line of modular homes, specifically tiny homes.
Yeah.
I know, nice. I asked one of the executives there. I think two of the executives were there. They operate out of Brampton. I asked them, what can you give me a ballpark price on a 2-bedroom bathroom, 2-bedroom, 1 bath, tiny home, garden suite. They'll do it modular. They'll pour the pad too. So between just the 600 square foot house and the pad, he ballparked me 175,000.
Come on.
Yeah, we're gonna. I meant to mention to you, we'll probably go visit them. Probably in a few weeks, in case you're interested. Sorry, listener, I'm just talking to Steve. We're just having a private conversation.
What's your calendar like next week? Yeah, no, totally get it.
They're actually breaking ground. He was saying that they'll have their permit in a week, and they'll break ground in 2 weeks. For their very first one. But this price point is for the listeners' benefit. Again, and then they said like this utility hookup still, we still need that. So they're saying that could range between 10 and 35,000. But still, we're talking about like 200 grand, somewhere around 200 grand for a tiny house. Versus if you were to build it from scratch, stick frame, the prices we've had folks talk on the show is like high 200s, maybe 300,000.
300,000. And take into account the rent rates, right? Like we're seeing very strong rent rates on these things just because they look and feel like your own personal space. There's no noise transfer. We're not dealing with like footsteps over top of you. You're not dealing with like low, shorter windows, darker feel. Like it's your own place. So yeah, I think this is very, very much front edge thing, significant thing that's occurring in our marketplace. I think you need to be aware of it. I also think that the term garden suite is also, as a person looking for highest and best use, I am finding myself that I'm getting tunnel vision. So I've worked very hard in the last maybe 6 weeks to not just get so uber focused on certain parameters that have to be on a property in order to get a garden suite onto it, because the way Bill 23 is written, it's looking for density on existing infrastructure that can be within the same footprint or an additional footprint of the house. So depending on what market you're going to, you may find it easier, or even within the city, you may find it easier to do an addition than to do a garden suite. Maybe that's the truth, but you just don't want to get such tunnel vision that you're like, I got to fit a garden suite on this thing. I am now looking at certain parts of the city with the mindset garden suites work here, and certain parts of the city that say maybe, but maybe it's an addition. And I think that being able to be a little bit more flexible is going to help you as well.
Right. Always think
because
use.
Just highest and best use all day long, right? And kudos to all the smart people, Ryan Carr especially, who've pushed that through my brain over the years. I think that it's a smart thing to do, and ultimately it is your future. There's no way you can make $3, $4, $5 million houses if that's what it will be in 10, 15 years from now. How do you make that work for the average person? It's just not going to happen. So you need multi-generational income coming from the same. That's my take on it.
Yeah, a great point, Steve. Like we've focused a little bit too much time on garden suites, garage suites, but I cannot agree more. We're at a higher level. You and I are always thinking about like, how can I add anything? How can I add a second suite, a third suite, a fourth suite, even a fifth? Right? They all have different complexity, so it's not the easiest for a beginner. But again, because we're living it, breathing it, and also because we're friends, we're all doing it. It's a little bit easier for us to understand. So can you give me another example of a property that you're looking at or just done recently with a client?
So we have a current student rental that we've just firmed up on. You want to do a student rental or you want to do a duplex? I just did a duplex deal 2 weeks ago. Just do student rental. Okay. So we have a student rental that we've just firmed up on. It was a very long due diligence process for this property for us and our client. But it's gone really well. And by doing it, we've really, looked through this property with very close eyes. It will be on, Union, which is a main thoroughfare in Kingston. It's a beautiful old red brick home. And it will be an addition put off the back. Now, there is existing students coming in with that deal. So we've got some time. There's some revenue coming in that's going to buy us some time. Now, but there's a good example in the case where is that revenue from this student rent positive on this property? The answer is no, it's not. Theoretically, in its first year, it will be cash flow negative. That is just the facts of that property.
Mm-hmm.
But because
we for a development project,
no, and it's no different than
no developer cash flows day
exactly.
one.
No, right? So like that's a thing you've got to get your head around sometimes. I know for a lot of people that's a deterrent. It's like, how do I carry all of these things? But if you have the means and you're able to see the long term, for our client, it's like, look, you're going to be doing an $8,000 all toll at the end of the year. It's an additional $8,000 you're going to be paying on this property. That's just built into our budgeting and our scheme. And it's part of the carrying to get us into April of next year. The good part is that there's no way that we're doing this renovation. The actual construction needs time. It's going to need some really good planning and some time to put through. There's no point rushing that. So this project will allow us to take the next 3, 4, 5 months to get all of our ducks in a row, get all of our professionals in line, submit to the city, have our conversations. It gives us lots of time to do everything we need. And we hit the ground running in early 24 to get this project built out with an addition on the back half, which will turn it into a complete triplex.
Sorry, is this the one that you're just putting an addition on, as you call the bump?
That's right. Yeah. So it'll probably be, it's hard to say specifics. It will be its own separate unit, 2-bedroom scheme with one bath, 2-bedroom, 1 bath, full kitchen off the back. The second floor of this current house, and then there's a loft on the top. So those two, the second floor and the loft, will combine to unit number 2, and that'll be a 3-unit property. And then on the main floor, we will be doing most likely a 2-bedroom, 1 bath mix on the main floor of the house. If all works out, what am I at? That's 2, 3. So that's 7. If I can fit the other 1 bedroom or the extra bedroom on the main floor, which is the plan, so that we have a 3-bedroom on the main floor, a 3-bedroom on the second floor, and a 2-bedroom on the addition, that would be ideal. That would keep us within our 8-unit cap or 8-room cap. And that's kind of the plan, but we just got to go through the logistics of how that all lays out and plays out.
Can you explain to the listener the benefit of doing an addition versus a separate structure, like a garden suite?
So for this particular property, what made sense? It could have had a garden suite. We, by all accounts, could have done a garden suite. A lot of these cities are using a 10% lot coverage equation. So if you want to build a garden suite and your property has a total square footage, so your frontage times your depth, let's say your total square footage is 680 square feet. After you take that, or 6,800 square feet. After you take out the coverage of the building and the coverage of any other structure, you'll have an idea of how many square feet you can build your garden suite. So let's just say, for an assumption, it's 630 square feet is what you're approved at after your 6,800. Because we've had to reduce a couple things. So it's not a straight 10% equals what I can build, but that's the idea. In this particular property, we got more use from the existing lot by making it an addition than we did from putting it as a garden suite. We could cover up to 70% of the property roughly when we were all said and done, and our setbacks on either side of the property were more favorable that if we did it as an addition than if we did it as a garden suite. So there's a lot of moving parts.
Sorry, Steve, just for listeners' benefit, setback is how far the new structure.
How far, that's right. How far the new structure has to be off of your property lines on all sides.
Right. And it can be, in some municipalities, extremely restrictive. I believe one city to the north of us has like a 5 meter setback.
That's ridiculous.
That's
right?
ridiculous.
That's ridiculous. In this particular case, it was a 3.6 aggregate setback. Aggregate meaning that the combined distance on either side of the addition had to be 3.6 meters. So that's very favorable compared to what we were looking at with the garden suite, which
Right.
was, I believe, 1.6 on all sides and just different things. So it just made more sense to build it out. Just easier, yeah.
Easier,
and so
return on investment will be higher.
And you're adding to an existing beautiful building a new addition that will fit in line with this old Victorian home. So it's one of those things where the actual value of the property just all makes sense. The golf term would be you're playing it as it lies. we showed up and this is what was here, and it's been there for almost 100 years. This is how we're going to play this hand.
Right. Yeah. It's the highest and best use of the hand we've been dealt.
That's right.
But you did choose your hand.
Very, very, very specifically. There's a bunch of properties, right? Like, we looked at properties in and around this house for the last 3-4 months. We've been watching houses all around this property. But for one reason or another, they just didn't equal what this property had to offer. And it's not because it's, the best property. It may not have been on certain features, but when you take it as a whole, the deal makes the best sense for my clients moving forward. And so that's kind of how you've got to look at it. Now, you have to depend on your designers and your planners and your architects. So having that power team built into our system helps, because we can get very, very smart, educated people that are very familiar with dealing with the city to give you opinions on what is most likely possible.
Which is generally a better, in my opinion, because I don't trust anyone, I take that opinion over a commission salesperson. Let's just remind everyone that, even though we are commission salespeople,
as you say, as the commission salesperson in there, the problem that I have, with just pitching a deal and running away, is that ultimately, I can't sleep at night like that. So when I'm talking to designers, I've done as much research as humanly possible, other than going to school to be that designer, going through the planning, meeting with the city, fully doing the research before any clients were involved. That's the due diligence that the commission salesperson has to do. You have to go and find out all the information so that while you're screening property.
That's what we do. We can't speak for others.
Well, I have no intention to speak for anybody else. What we do is to make sure that you're taking that due diligence period, that study time, looking into everything you can possibly look into. You're not perfect, but you need to at least do the things you got to do to understand the plan for the city, for sure.
Because we're working with the consultants, the designer, the planner, to know that we can get our permit and that we can close our permit before we would ever waive conditions on a deal. And/or, just to add to that, and/or we're very clear of the not only, I wouldn't say risk, but of the avenues or channels that we have to take if there is a hurdle. So nothing ever works perfect, right? You may have to get a small minor variance on a setback on an existing structure. Nothing is perfect. The garage that we're talking about for the other property that we said that was existing, 900 plus square feet, that is not part of the bylaw. But we've spoken with the city. We've gone through with the planners. We know what is going to be asked of us to get through the process. And we're very confident that we can get to the other side with the people that we have on our team. At that point, it's on the buyer and the purchaser and the investor to do a risk reward analysis, and understand if this is the opportunity for you. Are you accepting of these terms? And if they are, then at least they have all the information they can gather. They're not making an uninformed decision. They have considered everything that they can. And that is the goal, to give everybody as much information as possible. Speaking as much information as possible, to for listeners' benefit, understand we can make almost double the commission selling a pre-construction condo, and it's way more or less effort for us.
I mean, that's boring. You want to talk about boring investment? That's boring.
Yeah, but you made the point though. Like, neither you or I can sleep at night knowing that our clients like negative $500, $1,200 cash flow a night per property.
Yeah.
I wonder how these pre-construction agents are sleeping at night, knowing their clients are just bleeding, and they themselves and those clients are likely losing
piles on piles and piles of money. I don't know. I think everybody is it's business, it's capitalism. There is a need and there is a desire, and I'm not trying to poo-poo on anybody, but I just feel like if you come at it with what is that, intellectual honesty, I guess is that the Chamath term? If you're coming at it with that type of position, I believe in this strategy. I believe heavily in this strategy. I believe that it is the future, and I really, really, really think that people need to start to consider it with more attention, because it's definitely the only thing I can see that makes sense. The numbers that we've heard from the builders is that it could take up to 9 years to get a piece of property from ground raw dirt all the way up to a condo high rise turned over and occupied. In these deals, we're talking about 24 months to get 8 to 10 units in the city of Toronto. To bring 3 to 4 units, it could be only 7 to 8 months. I mean, the volume doesn't, you can do more volume this way. It's the only way that the numbers make sense. And I just believe wholeheartedly in that this is the way to go.
Speaking of numbers, can you walk us through the numbers on this bump out project, on this addition project?
Yeah, so we've got the property we've purchased at around, I believe it's $845 is the purchase price. We are fully anticipating a construction budget somewhere in the neighborhood of $400,000 to $500,000. The current value of the property, when all is said and done, will be right around that same number of 1.3. After the pullback, we still are seeing 1.2 to 1.3 for a property like this, fully converted. Rent-wise, we'd be probably looking at currently student rental per room rents in Kingston are anywhere from $900 to $950 a room. We would be shooting for
I'm sure there's cheaper for crap.
There is definitely, by all accounts, there's a lot of cheaper. I'm talking about just a specific property. And generally, we're going to be looking for our same general mix of 2,000 to 2,300 for these units when they're all said and done. Utility separated.
Fabulous, Steve. All right, Steve, I've taken up enough of your time. Any final thoughts? First of all, where can people reach you? If they're interested in learning more about...
Find me on Instagram right. at iWIN on the east side. Underscores are in there, so you have to reach out. And sometimes I'm guilty of not checking all of my message folders in Instagram. I'm not the best at that, so if you do reach out, I'm in there. But reach out to our team. I would say is a good option. Calendly links and all of those things are available. QR codes are available. We have we are always doing our coaching meetings monthly, right? So they can always reach out through those. And generally, I'm not a hard guy to find, I guess. You can find me.
We'll put your cell phone number in the show notes. Don't worry.
Yeah, exactly. Give away all of my home address, everything. It'd be great.
Yes, the number. Yeah.
You asked me for parting thoughts. I'll give you one parting thought before I go.
Yeah.
I think that, and you and I talked about this before we went on, negative voices or just negative things that are going on. It's been a year of a lot of negativity. The macroeconomics, well, 3. Again, I'm already the optimist. Right?
The gold standard ended in 1971. All right, continue. Sorry.
My personal view is that I'm working very hard to embrace the opportunities and try to get to the point where you can see the positivity, because I know that there's a lot of bad things happening, but there's also opportunity everywhere. And I think that if people are open to it, this could be a really good time for you to start to learn and start to get into it. Start to take control of your own destiny and start to look at options that may help you. Maybe not today, but within the next 3 to 5 to 10 years. So reach out and find good people and start to look for things that may push you out of your comfort zone, but may help you in the long run.
It's a good point. We've been, I remember when we started doing duplexes, when we started doing basement conversions, and then we were way out of our comfort zone. Big renovation budgets, opening permits. We weren't sure if,
big renovation budgets. Yeah. It was new frontier.
Yeah. Well, actually, back then it was only like $35,000 renovation budgets. That's creeped up a little bit.
I would take those numbers today, but yeah, I think that at the end of the day, right? Like if you're ahead of the curve, it's going to be complicated a little bit more than when you're at the back end of the curve. By then, everyone's figured it out.
Yeah.
So,
but the prices will be a lot higher once everyone's figured it out.
Everyone will be moving on, and everything will change, and they'll have something new to talk about. But yeah, for sure.
Yeah, because like when we started, like again, our client owns the very first duplex in Hamilton, Ontario, for example. Right now, there's probably like 300 of them just in that one city.
That's right.
Prices have gone up significantly since we started. So and again, like properties are valued based on their income. That's part of the factoring. So if we're forcing our if everything goes to plan, which we've already been doing it, either get in now and pay today's prices, or you're going to pay tomorrow's prices, which will be probably $200,000 more.
Or focus on your business. Here, I don't know if that's true or not, if I'm just blurting something out. But look, focus on whatever it is that makes you money personally, and put attention there as well, because you need to figure out, you don't want to be using other people's money as a dangerous term, because it's true. But sometimes you get caught up very over leveraged. And so you got to watch yourself with all of these things. I think that's just human nature, and taking care of yourself and pulling back and focusing on yourself too is good.
Right. And like Steve's saying, we have opportunities for folks to focus on. We have a free we do a free webinar at least once a quarter on how we're investing, how our clients are investing, and we offer educational tours usually at least once a month as well. And the educational tours, a nominal fee, $20 plus taxes and fees. So we're not selling like 5-figure coaching here. we're helping people. We're offering people opportunity to buy the same properties we buy for ourselves. All right. Thank you, Steve. Thanks for doing this.
Appreciate you. Thank you so much.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.